You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Today's program is a rebroadcast from OIC's webinar program. Every month, we do webinars on a variety of options-related topics. Check out optionseducation.org for more information. Enjoy the show.
Thank you for attending the latest installment of the Option Industry Council's webinar series, Getting Started with Options. My name is Alexander Osinga, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar, moderated by OIC's very own Joe Burgoyne, we'll be discussing with a panel the basic language of options, how opening and exit trades work, and the other important details investors and financial advisors should know before they invest with options. And now, ladies and gentlemen, Joe will bring you our topic today, Getting Started with Options. Joe?
Alex, thanks so much, and welcome to everybody. Thanks for taking time to join us today. We're big at the OIC, in terms of building the base of knowledge, and we're lucky enough to have two team members today who do that day in, day out. You may know them, Bill Ryan and Mark Benzaquan, both from our investor services team. So these guys, we're going to go through, really a conversation over the next 45 minutes or so, offering their wisdom, years of experience, working with investors like you, and hopefully, we'll uncover some real wonderful nuggets of knowledge as we go through. Before, I bring those guys in, I guess we should just clarify that options do involve risk. They're not suited for everybody. Any examples we talk about today, certainly won't include commissions and things of that nature. But be sure to, if you're already using options, you know about the disclosure document, characteristics and risks of standardized options. If you're not yet using options, you can get that document through either the OCC or your clearinghouse or your brokerage house. For those of you who are new to the OIC, we're celebrating our 25th year of being privileged enough to just be out there educating investors on the benefits and risks of the exchange-listed product. And we are funded in 2018 and 17 by the OCC, the world's largest equity derivatives clearing organization, and the Foundation for Secure Markets. So it really is the OCC the clearing entity that sets the listed options market apart, because the OCC takes away counterparty risk. These are the 5 parent exchanges that make up the listed options universe. We've got the CBOE, NASDAQ, BOX, MIAX, and New York. A number of those exchanges have different exchanges based on their different models, but a total of 5 parent companies, as we've seen some consolidation over the last couple of years. And then for those of you who have joined us before and have heard me, you know this is one of my very favorite slides. It is a snapshot of option volume from inception in Chicago back in 1973, when we had 16 companies that had options listed on them. You may know only calls were available, really were actually allowed by the SEC for the first 4 years. It wasn't until 1977 when the SEC did allow for us to add puts to our offerings. So we started with 16 underlyings. We've now got over 4,500 individual companies, indexes, and ETFs. And as you can see, volume averages just over 4 billion contracts a year, which puts us in the neighborhood of between 16 and 17 million contracts a day. I think it's worth noting, you can see, after the late 90s, early 2000s, option volume really took off. Part of that, I think, was for 2 reasons. We got electronic access to the markets with the first electronic exchange, the ISE, coupled with dual listing, where you had all the exchanges competing for all the listed products. And that, I think, along with the advances in technology, helped option volume to sustain or actually have dramatic growth over the next 8 years or so. We've kind of gone flat line over the last 5 or so. But think about it. With volatility levels as low as they are, it's pretty remarkable that our volumes have been able to sustain at current levels. So that's, kind of our opening. We want to, get started by asking all of you who are joining us, do you currently use options? If you wouldn't mind just giving a quick answer to that. I hope you do know whether you're currently using options. Okay, so that's dynamite, because, basically 75% are not yet using the listed options product. It's very insightful for Mark, Bill, and I as we, start our conversation over the next 40 minutes or so. Bill and Mark, it is great to have you on board here. You guys, you're on the front lines every day with investors. Let me ask you this: with the investors you speak to, and Mark, I'll start with you. Why do you think investors that you talk to use options?
Well, Joe, first I want to thank you for having Bill and I as part of this webinar. We're always glad to talk to you and glad to talk to the investors as well. So hello everybody, and thank you for joining us. In terms of why people use options, the most frequent responses that we get, or that we can ascertain from our investors, is that they use options to generate income. Now, whether that's by selling options and generating income that way, or by leveraging their money with options, or simply as a protective measure, protecting the portfolio that they currently have against some downside risk. We've been in a bull market for pretty much as long as I can remember, and everybody thinks that the sky is going to be falling at some point in time, and options are a great way to protect, or options can be a great way to protect against that potential inevitability.
Okay, dynamite. So really income and then risk management. Bill Ryan, welcome. Do you have any different take on that, or do you hear the same thing from investors?
Thanks for having me, Joe. And, I pretty much have to echo what Mark said. Maybe a little shorter response. Traders, investors use options to make money and to save money. That's pretty much the same answer.
Beautiful. Let me go back to you, Bill. So, and you see 75% of attendees today are not using listed options. So let me start with you, Bill. You've got this open canvas. Where do you think is a good place to start when you're just, trying to build that base of knowledge in the options product?
Well, I think it's important for investors to be familiar with option fundamentals, know the ins and outs, and know exactly what's involved in an options contract. And of course, tooting my own horn, our own horn here, I'm of the opinion that the best place to learn about option basics and fundamentals is at the OIC's website, optionseducation.org.
Well, we offer yeah. Go ahead, Bill.
No, I'm just saying we offer visitors at the site at optionseducation.org an opportunity to take an assessment test to gauge their knowledge of the options product, and based on this 20 question quiz, a series of courses, videos, and podcasts will be recommended to the student, and it's a way to narrow your focus and nail down the fundamentals.
Bill, I know our website has a wealth of information there. How do investors find that 20-question assessment? And is that part of the MyPath program? You're absolutely correct. That is the MyPath assessment test, as a matter of fact. Okay.
And you can. We'd like to think the website's very intuitive, but if you have any questions about the content, we also have a chat feature or function there that we will wait and answer any questions from visitors at the site. So we can help you navigate around there too.
Dynamite, two good places to start. And again, just if you can't find MyPath, you can just plug in MyPath into the search bar at optionseducation.org, and the 20-question assessment test, I think, will jump up. Mark, how about you want to get us started with some of these concepts? Puts and calls, rights and obligations? How about it?
Yeah, absolutely, Joe. So, when it comes to options, there's two types. We've got calls and puts. And one of the things that you'll hear over and over and over and over is that buyers have rights and sellers have obligations. So when it comes to, we're talking options, the calls and puts generally represent the right to, if you're buying an option, I should say, it's giving you the right to buy or sell typically the underlying asset, which, as you can see here, is 100 shares of the underlying stock or ETF. If you're buying a put, it's giving you the right to sell 100 shares of that underlying at the strike price anytime before expiration. Now, you can see here options are contracts, and that's exactly what they are. Contracts convey rights and obligations. And like I said, this is something you'll hear over and over and over again. Buyers have rights, sellers have obligations. It's something that you need to drive into your mind and that you're going to see in your sleep. So this graph that we have here, this small little chart, options are very complex. They can be very difficult. They can be very hard to understand. But when you're learning something, when you break it down to its most simple facets, its most simple components, when it comes to options, there's only four things we can do. We can buy a call, or we can buy a put, we can sell a call, and we can sell a put. And that's it. Obviously, we can combine them in all different types of ways for different complex trades, spreads, straddles, flies, what have you. But when it comes down to its simplest form, there's only the four things that you can do. And this graph that we have here, this table, is one of the most useful bookmarks that you can have as a beginning options trader. When you buy a call, it's giving you the right to buy 100 shares of the underlying at the strike price anytime before expiration. When we sell a call, that's creating the obligation to sell those shares. When we buy a put, we now have the right to sell those shares. And when we sell a put, we now have the obligation to buy. So the buyers of options has the right to do what they will, to exercise their contract, to make good the terms of those of that contract in which they partake. The sellers of the options have the obligation to make sure that those terms are met. So again, buyers have rights, sellers have obligations.
Okay. Core concepts, that's what it's all about. We got an example here. You want to run through that, Mark?
Yeah, I'd be happy to. So we've got an example of a trade. We've got XYZ January 55 call at 2:30. Now, that's typically what you'll see when you're looking at making an options trade. And the question is, well, what does that all mean? Now, the XYZ, we're simply, that's representing the underlying. That's going to be the company in which you are buying or selling shares. So it typically represents 100 shares. So XYZ, January 55 call at 2:30, XYZ is going to be that underlying company in which we are agreeing to buy or sell shares at some future time. Now, that future time in terms of the contract, just like everything, just like all other contracts, they're not good forever. Option contracts expire too. In this case, we're looking at January, meaning the third Friday of the month, the third Friday of January. Option contracts also expire. They now have weekly expirations that expire on, every Friday. They also have, depending on the security, Mondays and Wednesday expirations also. So if you are looking at the ticker, if you're looking at this option symbol and it doesn't have a date and it only says the month, then we can assume then that is the third Friday of the month. Now, the next item there, 55, that's going to be our strike price. That is going to be the price at which we agree to buy or sell those shares. The call, again, we talked about calls and puts. In this particular case, if we are buying this option, we are buying the right to purchase 100 shares of the stock, XYZ, between now and the third Friday in January for a price of $55. That call, buying that call, is giving us the right to purchase shares. And then the last item you see there, $2.30, that's going to be the premium. That is going to be the price for which this contract trades. We're buying the right to buy these shares at $55, but that right is going to cost us money. That right is, in this case, going to cost us $2.30 per option contract. And because most option contracts represent 100 shares of stock, we're going to take that $2.30, multiply it by 100, so it represents a real-world investment of $230. If you're the option buyer, that is what you're going to pay for this option contract. If you're the option seller, that is the premium that you are going to receive for this option contract.
Well said, Mark. And, for our listeners out there, these rights and obligations and the example that Mark just went through, this really is the foundation of the listed option space. Options can be complicated, but they absolutely don't have to be. And so you can see a lot of this stuff is just straightforward. Bill Ryan, anything you want to add in terms of, the rights and obligations and keeping these core concepts straight?
Well, Mark mentioned the useful graph or chart, we'll say, the four-square graph. Both Mark and I have a copy of that cut out and pasted by our screens at the office. It doesn't hurt to have a constant reminder. One thing I did want to point out, though, in Mark's wonderful anatomy, description of an options contract, when an option trader, for example, if we were to buy this options contract, this XYZ January $55 call, because we forecast a rise in the stock between now and January, we would be buying that options contract and we would be buying to open a long position in this particular call option. So and that's important because when we create this position, when we buy this options contract, we are purchasing the right to own the stocks, and we are opening an option position. At some point in the future, should we decide to sell this same contract back into the marketplace, perhaps we can sell it at a profit. We would be selling to close our previously long position. We'd be selling to close our contract. We would not be undertaking the obligation. If we were to sell this call option, we would not be taking on an obligation to deliver the stock. We are simply closing our long position in the options marketplace.
Thanks for pointing that out, Bill. That's that open and close is important for those of you, when you enter your option trades, you do have to designate whether open or closing. So thanks for that. Before, Bill, I get to asking you about, who's responsible for making option prices. Can you just maybe go over the whole concept of the strike price one more time, just so people are clear on what the strike price is versus the underlying price?
Well, the strike price, I guess historically, this is the price where the buyer and seller would strike the deal to buy or sell the underlying security, hence the term strike. But that is in our example here, the $55 strike price. That is the per share price that we would pay should we decide to exercise the call. We have the right, as an call option holder, we have the right to buy the stock at $55 a share at any time between now and the January expiration.
Okay. Thanks for clarifying that. I think I know when I talk to investors, sometimes the whole idea of the underlying price and the strike price gets confusing. So, thanks for that clarification. A couple questions I want to ask both you guys, and Bill, I'll come back to you first. Who makes option prices, and how do we know what an option price is worth? So maybe we'll start with, who makes option prices?
Well, the options market, or I should say option prices, are determined by participants in the options market. That could be an individual investor. That could be an institutional firm buying or selling options. It could also be a market maker or specialist at the exchanges themselves. But the true value of an option, the price of an option, is determined by buyers and sellers.
And okay, and how about Bill? You want to run us through this whole idea of option premium, the intrinsic value and the time value concepts?
Well, sure. In our previous example, we had mentioned the $55 call trading at $2.30. In our example here is a $3 premium, but an option buyer pays the premium, the price for that options contract. Once they buy that options contract, it's non-refundable. You can't get your money back. And an option seller, the other side of this trade, the seller receives the premium, and they keep that no matter what happens, no matter if they are assigned or close their position out later. The fact of the matter is the premium they receive is theirs to keep.
Well, can I ask you about that whole idea of non-refundable? All right, so we're talking about a contract that you buy for $2.30, and so times 100, you put out $230. But you can turn around and close that at any time, correct? And then recoup whatever's left, either a profit or at a loss, correct?
Oh, absolutely. Any day the options market is open, option traders would have an opportunity to close their position out. And should your forecast of a rise in company, world famous XYZ, I should say, should that option premium rise in value, you can certainly sell that options contract back into the marketplace as a closing transaction, and the difference between what you paid for it and what you sell it for is going to be your profit or loss.
Okay, so you can, it's not like you pay the $230 and have to hold that thing to expiration. You can get out anytime if you wish. Okay.
And you know what, Joe, if I can just jump in for a second here. Yeah. Just one thing to point out to people, to expound a little bit on what Bill was saying, is what people don't understand is the majority of option contracts out there do not live to see expiration. Over 70% of all option trades, and certainly, a straight buy or sell of an individual option, over 70% of them get closed out in the market, like Bill had just explained. You buy something for $230, your forecast is correct, now the option's trading for $3. You turn around and you sell the close in the market for $3, you've made your 70-cent profit. Very few option contracts actually go through expiration, and, I'm sure we'll talk a little bit about exercise and assignment a little bit later, but very few option contracts actually go through that exercise and assignment process. The reason being is because the overwhelming majority gets closed out in the market ahead of time. So again, just because you buy something or just because you sell something up front doesn't mean that you can't turn around and trade out of it throughout the life of that contract.
Good detail, thank you. Bill, how about the intrinsic value and time value aspect of an option price?
Sure, Joe. It's important for option traders and new to options traders to understand that an options premium is comprised of two components. It has two components. It has the intrinsic value component. That's the in-the-money amount. And we have a sort of a catch-all component known as time value, and that is defined as any premium in excess of intrinsic value. At expiration, at expiration, on the last trading day before a contract expires, an option will be worth only its in-the-money value. It will have no time value. That makes sense. As the expiration date approaches, we're running out of time, and your options contract, if it had any time value, that's running away too. That's running out too.
Okay, makes sense. Again, listeners, we're just building on, basically it's somewhere in the neighborhood of 8 to 12 core concepts: rights and obligations, calls and puts, intrinsic value, time value. I think Mark's got a few that he wants to talk about in terms of in the money, at the money, and out of the money. Go for it, Mark.
All right, Joe. When it comes to in the money, the way that I look at things is this. Let's say we're talking about a call. And if I'm buying a call, again, that's giving me the right to buy shares at some future point at a specific price. I think our example earlier was the January 55 call. So it's giving me the right to buy stock at $55. Now, am I going to want to exercise that contract? Am I going to want to enforce the terms of that contract if stock is trading $50? Am I going to want to buy those shares at $55 by enforcing my contract when I can buy them in the market for $50? Well, of course I'm not going to want to do that. So the in-the-money amount, technically it's the amount of the option, it's the intrinsic value, it's the amount of the option that is, when it comes to calls, is the strike price is beneath the share price. With puts, it's the opposite. The strike price is above the share price. But the way I look at it is, where do I make money? Am I going to make money on buying stock for $55 when it's trading $50 in the market? Of course not. I'm only going to make money if my share price, if my strike price is below that of the share price. And again, I'm talking about buying calls. So the in-the-money amount is going to be, where do I make money on this? With puts, I want to go ahead and sell shares above the market price. With calls, I'm going to want to buy shares below the market price, and that's going to be the in-the-money amount. Now, the at-the-money amount...
Let me stop you there if I can. So it's all about the money for you, huh, Mark?
I mean, really, isn't that the reason why we're all here for the most part?
Let's, on the call side, if you would, give me a price of a stock and a strike price that's in the money. XYZ, okay?
Absolutely. Let's go back to our original example, that $55 call that we were looking at for January. That $55 call is going to be in the money if the share price is above $55. If the share price is $55.01 or more, that option is going to be in the money. If it's puts, it's going to be the exact opposite. That $55 put is going to be in the money if the share price is below $55. And again, I'm going to want to buy stock below the market price. I'm going to want to sell stock above the market price. So, looking at it from buying calls versus buying puts, with buying calls, I want to buy shares below where I can get them in the market. Buying puts, I'm going to want to sell those shares above where I can sell them in the market. And that's going to be the intrinsic value, as Bill was mentioning. That's also going to be that in-the-money amount. Out of the money is going to be everything else. So out of the money is going to be all time value, which we'll get into in a little bit, I'm assuming. Time value is everything beyond that price. So when it comes to an option, you've got the two components, intrinsic value and time value. The intrinsic value is simply going to be that the difference between the strike price and the share price. Time value is going to be the rest of the option premium that isn't accounted for by intrinsic value.
Okay, so and you explained it well, but could I ask you again, we got the $55 stock, so those out of the money call strikes and put strikes would be which ones?
Okay, again, $55 stock, if you had a $56 call, a $58 call, a $60 call, et cetera, those are going to be out of the money, right, because you're not going to want to buy shares for $56 when you can get them in the market for $55. You're not going to want to buy shares for $60 when you can get them in the market at $55. And then conversely on the puts, it's going to be below that share price. So I'm not going to want to sell stock at $50 when I could sell it in the market at $55. So for a $54 put, a $52 put, a $50 put, et cetera, those are all going to be out of the money with the stock price trading $55.
Makes sense. Bill Ryan, anything else you want to add on this whole idea of in the money, at the money, and out of the money?
Yes. Getting back to the question, and Mark touched on it earlier, how the vast majority of options contracts are closed out prior to expiration. Occasionally, we'll receive questions from traders and investors and say, can I only sell my options contract if it is in the money to close my position? And the answer is absolutely not, although it would certainly help. The fact of the matter is, if I were to have purchased an out-of-the-money call option, this January $55 call, for example, and perhaps the next business day, the stock started heading in my forecast direction, it started heading toward 55, that call option that I bought at 230 may rise in value even though the stock has not risen above the strike price. Perhaps it's moved $1 or $2 closer, but is still considered out of the money. But that options contract could now be worth $3, and I paid $2.30 for it. So it's not necessary to wait to take your profit on an out-of-the-money option. Just I guess we'll say an observation, Joe.
Okay, very good. I almost hesitated to get into pricing components, also known as the Greeks, for folks getting started. But actually, it does make sense. And again, these are pretty straightforward concepts. So, Mark, would you like to just kind of run through kind of quickly what the pricing components or the Greeks are? as they relate to options?
Yeah, sure, Joe. When it comes to option pricing, we talked about intrinsic value, time value, and time value has many different components. But the way that those prices change certainly depends on the Greeks. And the Greek that probably most people are familiar with is delta. And what delta tells us is that for every dollar the underlying changes, for every dollar that the stock changes, the option is going to change by a certain amount, a certain percentage. And that percentage is delta. If you've got a $100 stock and you buy an option that's got a 60 delta, and that stock moves up $1, that option, all other things considered remaining the same, that option is going to increase by 60 cents. It's not going to move dollar for dollar. It's going to move by the delta. So again, a 60 delta means that, one of the definitions, I should say, because there's, dozens of them out there, but one of the main definitions of delta is how much that option price is going to change, as you can see here, versus the changing stock price. For every dollar the stock moves, how much is that option going to move? Now, another one.
Let me ask you this, Mark.
Yes.
Before we jump to something else, so how does an investor know what delta a particular option is?
Well, typically on their options chain, which is going to be a table, the options chain is going to be. Hello? The options chain is going to be a table. The options chain is going to be a table of various strikes and various expirations, what months are available to trade, et cetera. And it's also going to have all of those option prices for all of those available strikes. Depending on the trading platform or the educational platform, I know, for example, on our website, optionseducation.org, we have a quotes page, and in addition to all of that information I just mentioned, it includes the Greek. So it's going to show you what the delta is for that specific strike. So back again to our original example, the XYZ January 55 call, you're going to look, it's going to show a price. Remember, we talked about that $2.30 premium. It's going to show that premium, and it's also going to show you what the delta is of that option. And again, that's going to be how much the option price is going to change in relation to a change in that share price.
How about a few more?
Okay, well, another one that most people are concerned with is theta. Now, theta is also known as time decay. Again, when we talk about options, it's a contract, and it's got a certain lifespan. The value of that option, and you can think of the analogy, time is money. Certainly something that I've heard, for the decades that I've been in the business. Time is money. And simply what it means is the more time in terms of options, the more time there is, the more it's going to cost you. If I'm an option seller and somebody wants to buy an option from me that's expiring next week, I have a pretty good idea of what's going to be happening with the market, and so therefore there may not be that much risk, and I know what I'm willing to sell that option for. If somebody wants to buy an option from me that's not expiring for another 2 years, well, anything can happen during that time. So I've got a lot of risk that I'm going to be looking at. So I'm going to be requiring a larger premium because anything that can happen during that time period. With the theta, that time decay, what it tells us is as we approach expiration, the value of that option is going to decrease. It's going to decay as we approach expiration. Now, that decay isn't going to be constant, meaning that you're not going to be losing, a couple pennies a day from here until that option expires. You may be losing a couple pennies a day, from now, depending on how long the option is, for maybe a couple weeks, and then maybe 30, days prior to expiration, that time decay really kicks in. It accelerates. Rather than losing a couple pennies a day, maybe you're losing 3, 4, 5 cents a day. 2 weeks before expiration, now maybe it's a nickel to a dime a day. The week of expiration, the day of expiration, now all of that time value, as Bill had mentioned earlier, gets sucked out of the option, and the only thing left is intrinsic value. So that theta, that time decay, if you think of it as a curving slope, that with a much increased acceleration or a much increased slope at time of expiration, that is really what theta tells us. It's telling us that the option is going to be losing money at a more rapid pace the closer we get to expiration. And, delta and theta are really two of the big Greeks that people look at. Certainly there's other things there. There's vega, which, we haven't talked about implied volatility yet, but that's one of the biggest components of option pricing. And vega is telling us how that option price is going to change as the volatility changes. Gamma is, telling us how the delta changes compared to the option price change. The stock price change. So, there's a lot of different things. There's a lot of different components that go into making up an options price. And then there's a lot of different factors, the Greeks, for example, that, tell us theoretically how that option price is going to change based on a number of factors in the market, whether it be time, stock price, volatility change, et cetera.
Mark, Mark and Joe, real quick, I just want to point out that these Greeks that are the results of or the output of various option pricing models are just that. They are pricing models. They are not written in stone. If your brokerage firm says that this options contract has a delta of 50 and the stock moves $1, we'll say it's a call option, it's got a delta of 50 or 0.50, and the stock moves $1, there's no guarantee that that options contract is going to move 50 cents. It's a way to manage the trader's expectations that we expect that this options contract will move 50 cents to the dollar, or we expect that as one day passes on the calendar, the option price is going to decline by, roughly a half a penny. So it's just important to remember that these are theories. They're not ironclad rules or laws.
One of the great things about, the listed options market is option pricing is so dynamic, and these pricing components do change over the course of the day and sometimes impact prices significantly. Are there resources? Again, 3 out of 4 listeners tonight don't use options. Where can they go to find out? Are there simulators or pricing calculators? I mean, I know we have some stuff on the site. What would you recommend? Bill, why don't you run with that one?
Well, Joe, we at optionseducation.org, we've got option pricing calculators, and almost all of the heavy lifting has been done by the company that provides us this calculator. For example, if you were to input a specific stock, the calculator knows if and when they pay dividends, for example. They will also provide you with a volatility number, a historical volatility number. So pretty much all of the inputs that go into a pricing calculator are provided to the user on our website. It's an incredibly helpful tool. We've also got we also have a number of educational resources that speak to and discuss the concept of option pricing and option pricing models. We've got 2 online courses that discuss this, and we've even got a couple of videos that are archived webinars that discuss some of these other concepts. Volatility is, as Mark mentioned, is I would say it's the most controversial input or the most controversial topic when it comes to options pricing, because we could have 2 option traders could have a specific stock in mind, and they could also have 2 wildly different volatility numbers. The reason they could have these different numbers is the look back period. What sort of time frame are we talking about of the movement in the stock? One trader may have a volatility number of 75%. Another trader might have a volatility number of 45%. That difference could be explained by the lower volatility number being derived from a 60-day time frame, and the 75% volatility number could be derived from last week when the company announced their earnings.
Okay. Again, the dynamic aspect of the options market is what I think makes it so stimulating. Mark, any ideas there, or you want to move on to exercise and assignment?
Well, you know what, Joe? It's funny that you use the word dynamic. I was on the trading floor for 18 years, and one of the most used sayings that we had on the trading floor was that it's a dynamic marketplace. Whenever an investor or a market maker or an institutional firm would be unhappy with a price in the market, when they would call for a quote, that was certainly one of the things that we would always say. You know, it's a dynamic marketplace. I know that you expect the option to be worth X amount of dollars or the market to be such and such, but it's a dynamic marketplace, and often things aren't always as they appear or what you think they may be. You know, Bill had mentioned volatilities, and he had also mentioned earnings, which for those of you that attended last month's webinar, and I believe Alex can give you information on that in terms of some replay information or where that's available. But one of the things about trading earnings and volatility specifically is earnings are an unknown event. Leading up to earnings, it's an unknown event. And as I mentioned earlier, that if you were going to trade an option 2 years down the road, there's a measure of risk there, and as a seller, as an option seller, you want to be compensated for that risk. Volatility is really no different, or I should say earnings season is no different in terms of volatility. You don't know what that event is going to be. Volatility typically gets bid up, and what that means is that option prices get more expensive heading into earnings season. Once that unknown event becomes known, now volatility typically will reduce or return to previous levels. Option prices will return to previous levels. And, you know, Bill had mentioned that these are all theoretical concepts, the Greeks, for example. So you may be on the right side of earnings. You may think that the company's going to have great earnings and the stock price is going to go up, so you go ahead and buy an option. Well, it turns out that the stock price does go up, but because those volatility levels decrease, because, again, that unknown event is now known, that decreasing volatility, that just hurt your long call. Your long call was worth $2.50, stock goes up, but because the volatility came in, as we would say on the trading floor, because that volatility came in, now that option may still only be worth $2.50, or it may be worth less than you paid for it, even though the stock price went up. So again, you know, just as a general observation when it comes to volatility, especially during earnings season, it's a very, very, very important pricing concept, and that, you know, around earnings season, you know, investors can certainly, you know, bite off more than they can chew. So, you know, if you're trading earnings, definitely, you know, be careful around there. And then again, that previous presentation that we had a little over a month ago, definitely check that out, because it's got the whole presentation is talking about trading options during earnings season.
Fantastic. And, go ahead, Bill.
No, just say a quick reminder to visitors at the optionseducation.org website. When you do pull up an option chain, simply by entering in the stock ticker symbol, if you were to scroll down to the bottom of the option chain, there is some very helpful volatility information about that specific security. And there's even a chart, and it's not, the viewer or the visitor should not be surprised to see the volatility behave in a very cyclical fashion, much as Mark mentioned, you know, just prior to earnings season, we would expect that volatility to start to climb. But the charts and volatility information on optionseducation.org are incredibly helpful. And if you're new to options, it's a wonderful way to visualize a very esoteric topic.
Lots of stuff on that website, that's for sure. Let's see, we got 2 more concepts we want to talk about, Mark and Bill, before we go into maybe a rapid fire because we're getting so many questions. It's great. Mark, how about if you cover exercise and assignment for us, and then Bill, you can add something, and we'll get to rapid fire on the questions.
Okay.
All right, sure. So exercise again. An option is a contract, right? You're buying the contract that gives you rights. You're selling the contract. You've got obligations. Now, as an option buyer, let's say we stick with buying a call. You're buying the right to purchase stock at a specific price within a certain period of time. Now, if it gets to the point where that option contract expires, or any time in between, if we're talking American-style options, the option holder, the option buyer, may decide that they want to go ahead and exercise, or they want to go ahead and make sure that the terms of that contract are fulfilled. They may call for that exercise to where they are going to pay their strike price times $100 for every option contract they have. And in return, they're going to receive typically 100 shares of stock. So if we're talking on expiration Friday and their contract finishes in the money, remember we were talking about in the money where it's the strike price is below the share price if we're talking calls, the option holder would exercise their contract and they would call for the writer, the seller, to fulfill those terms. So, Joe, you and I enter into a contract. I buy a call from you. You sell it to me. And we won't get into the random aspect of assignment, but let's just say you and I are the only 2 market participants. I decide I want to go ahead and exercise my call. I bought a $55 call from you and the stock's trading $60. So I go ahead and pay my strike price times 100, which would be $5,500 for every option contract. In return, you deliver to me 100 shares of stock. Now, what I do with that stock is up to me. I could keep it. I could hold on to it. It's trading $60 in the market. I can certainly turn around and sell it in the market and pocket that $500 profit. That's entirely up to me to decide what I want to do with it. I have the right as a buyer to exercise that contract. Now, you, Joe, as a seller, you have the obligation to accept assignment. And what assignment is if you get assigned on a call, if you get assigned on a put, where you need to fulfill the terms of that contract. You need to live up to your obligations. If you get assigned on a call, you need to deliver 100 shares of that underlying, and in return, you get your strike price times 100. So that $5,500 that I paid, it goes into your pocket. The 100 shares of stock that you have goes into my trading account. Now, again, the assignment it's a completely random process that, we can talk about it another time, I guess, or listeners, attendees, if they have any interest, they can certainly, drop us a line at the OCC and at the OIC, and we'd be happy to talk to them about it. But, what the assignment is simply the short writer or the short contract holder lives up to the terms of that assignment. Again, whether it's being put shares or delivering shares, and in return they either pay for those shares or they collect the money for them. But again, buyers' rights, sellers have obligations. Buyers can exercise, sellers get assigned.
Okay, sounds good. Bill, we got different exercise styles. You want to race through?
Sure. Yeah, absolutely. Exercise style, there are 2 exercise styles, American or European. It has nothing to do with geography. American exercise style means the option can be exercised on any business day. And of course, on the flip side of that, of course, is you can be assigned anytime you have an open short position. Anytime you have sold to open an options contract, you can be assigned. American style, or I should say equity or options on individual stocks and ETFs are almost always American exercise style. They can be exercised on any business day. If and when you exercise, the deliverable is physical securities. You have to buy you will buy or sell stock. The assignee has to buy or sell physical shares of stock. European exercise style means the option can only be exercised at expiration. We don't see too many equity or ETF options with this European exercise style. Typically, this is reserved for cash-settled index options. The most, some of the more popular ones would be, for example, the S&P 500. SPX is a cash-settled Euro-style index option. Whereas settlement in American or stock or ETF options is physical delivery. When you are assigned on a cash-settled index option, you simply pay the difference between the strike price and the settlement value of the index. So basically, you're on the hook to deliver the intrinsic value.
Okay, so American and European, good explanation there. We got lots of questions coming in, a couple on exercise assignment and then far more. So how about if we get going with questions, guys? Bill, I'll come to you first. Can I exercise my option early? And if I do, what happens to the premium?
Well, the premium has already been spent. Quick answer is yes, you can exercise your options contract early if it's an equity or ETF option. What happens to the premium? Well, the premium you paid for the right to exercise the option is going to be added to the cost basis when you, for example, when you exercise a call and you paid $2.30 for a $55 call, and you exercise the $55 call, you own that stock at $55 plus the $2.30 premium you paid. So you own the stock at $57.30.
Okay, very good. Mark, if I want to avoid assignment, okay, so my obligation when I sold the contract, is there anything I can do to avoid assignment?
Absolutely, Joe. And the only thing that you can do to avoid assignment is, as my partner Bill is want to say, the only thing that you can do to avoid assignment is not to have a short option contract to begin with. Now, what that means is you've got a short contract, you sold an option, you sold a call, you sold a put. The only way to avoid assignment is to buy that option back prior to being assigned. And that's all you can do. You sold it to open, you buy it back to close, and once that happens, you are out of the security. You no longer have an open position. You no longer have risk of assignment. That is the only thing, the only way that you could avoid assignment is not having that assignable position to begin with.
Mark, in trading floor lingo, we say you're flat, right?
Right, exactly. And another thing that we say on the floor, Bill, is you remember, when in doubt, close them out.
Right. To remove all doubt, close them out. There you go.
Right. If you don't want to get assigned, close out that position.
Amen. Bill, coming to you. Risk reward is so important. One of the attendees is asking, how can I measure it with my option position? How do I know the amount of risk in my option position? That's a big question. Bill, why don't you hit that, and then maybe I'll come to you, Mark.
Well, for almost every type of option strategy, we can draw up a profit and loss graph that measures how much we have at risk and what our possible rewards could be. Again, talking about optionseducation.org, we have somewhere in the neighborhood of 42 different option and stock with option strategies, fully explained. Maximum gain, maximum loss, or we'll say max gain, max pain are described. We also, in these same strategy areas, talk about, mention about the break-even point. Where must the stock be for me to break even on this trade? Sometimes break-even is really the best you can hope for. Ideally, we're making money, but sometimes breaking even is the best we can hope for.
Okay. And Mark, any thoughts in terms of the whole risk-reward aspect of an option position?
Well, just to build off of what Bill had said, the drawing your profit and loss chart. I gave a presentation in Las Vegas a couple of weeks ago, and one of the points that I tried to hammer home to the attendees was the importance of drawing that P&L graph. seeing where you make money, seeing where you lose money, how much can you make, how much can you lose. It's the easiest way to visualize those concepts. Now, getting back to what we were talking about earlier with delta, I had mentioned that not only was delta the amount by which the option may move as the stock price moves, but another definition that some people use is that delta is the probability that that option contract is going to finish in the money. So with our example of a call that we were looking at with the 60 delta, some people interpret that as a 60% chance that that option contract is going to finish in the money. So options with a higher delta may have a higher probability of finishing in the money. Options with a lower delta, a lower probability. And option sellers, for example, would look at that to determine, if I sell this option contract, what's the chances that I'm going to make or lose money on this? And some investors look at delta. So it's certainly something to consider.
Very good. I'm going to ask you about this one too. Bill, how many option strategies should I try to get good at is a question.
Wow. Well, I'm thinking there's probably 3 or 4 strategies that are essential for any type of investor, particularly the stock investor. That would be, for a stock investor, that would be covered call writing, protective puts, perhaps the collar. For the new to options investor who may be perhaps a little bullish on a security, thinks the stock is heading higher, a simple long call strategy is easily understood. The P&L is can be, we'll see the classic hockey stick diagram with a covered call. A long call position, and as Mark said, there's only 4 things you can do with an options contract. You can buy a call, you can buy a put to open positions. So of course we'd want to take a look at buying a put option to open a position. Well, there's 4 right there.
Very good, Mark. Anything to add on that question?
Yeah, Joe, and it's funny because we do get asked this question. Bill and I, we get asked this question often, and the way that I always put it to investors is this: pick 2, maybe 3, but let's start with 2. Pick 2 strategies that are good for a bullish market, 2 strategies that are good for a bearish market, and 2 strategies that are good for a neutral market. Now, again, not to sound like a commercial, but you can go on our website, optionseducation.org, and we have a strategy screener that lists almost 4 dozen different strategies, and you can filter them based on bullish, bearish, neutral, in terms of, and then there's additional categories that you can filter. But my point is, you can pick 2 basic bullish, bearish, and neutral strategies. Learn them in and out. Give us a shot with questions that you have about these. Pick just 2 for each market movement or no movement at all, and become an expert in that.
Excellent. And attendees, as Bill and Mark both said, the website is full of enormous information. That's optionseducation.org. Mark, how can investors best reach you guys, and what hours are you guys, when I say you guys, it's Bill, it's Mark, and we also, colleague Ed Modla joins the team. So what are your hours, and how can investors best reach you?
Well, we're open every trading day. We are there from 8 a.m. Central Time to 4 p.m. Central. The easiest way to reach us is via email at options@theocc.com. You can also go to our website, optionseducation.org, where we have a live chat feature that has become very, very popular. So, the 2 best ways to reach us, online via chat or via the email. And one thing that I just want to mention, I've been in the business for, and Bill even longer, but I've been in the business for going on over 20 years now. 18 of that was on the trading floor. And, man, if I knew that the OIC existed, specifically our website, as a resource for beginning to intermediate option traders, that would have, put me on a whole different career path. It's such a phenomenal resource that, I'm so happy to be a part of, to get the word out, simply because, the investors that I meet, the investors that Bill and I and Ed talk to, they really get something out of it. And the fact that we have live options help through our investor services team is an invaluable resource. And certainly the price is right? As a not-for-profit organization, everything that we offer is completely free of charge. You really can't beat that.
Amen. And Mr. Ryan, any closing thoughts, buddy?
Those are great sentiments by Mark, and I agree 100%. Additional closing thoughts. It's important to do your homework. It's also important to ask questions before you start trading. Mark and I have both had the not so happy experience of talking to and explaining to option traders what has happened after they've made a mistake, after they've made a trade that they did not want to do. So my one thought there in that regard is ask questions before you decide to make that first trade or two.
Good advice. Mark, anything else?
Not really that I can think of, Joe. Just that, again, encouraging everybody to visit our website and to make use of our investor services team. It really is an invaluable resource. And again, just to thank everybody for their time. I'm sure, on this Wednesday afternoon, people have other things to do. So I definitely want to thank everybody for joining us today. And Joe, thank you for having Bill and I. It's always a great time to talk to you.
It's a pleasure, and thank you both. And Alex, as I turn it over to you, just for our listeners, those core concepts, knowing what the call and the put are, rights and obligations, exercise and assignment, the whole idea of intrinsic and time value, in the money, at the money, and out of the money, as well as maybe a couple pricing factors, and that should offer a lot of confidence if you can really get to learn those concepts. So with that, Alex, I'll just thank Bill and Mark and turn it back over to you.
Thanks, Joe.
Ladies and gentlemen, thank you for your time today. While we weren't able to get to all of your questions, we have our investor services, like Joe indicated, ready to help. Feel free to reach out to them at options@theocc.com. Again, that's options with an S at theocc.com. Again, today's session will be archived and will be accessible in a few hours using the same link you used to join us today. For those interested in further options education, as the team mentioned, please visit optionseducation.org, the OIC's website, and see the Getting Started section for further reading. And of course, make sure to check out optionseducation.org in the upcoming weeks for our next online session. You can also access our upcoming webinars via the URL link at the bottom of your console, which will take you to the events registration page. Thank you again for attending, and we hope to see you again next time.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.